Why are you here? Why are you here? And you're saying, hell, I sometimes wonder. Folks, the purpose of our profession. What's the purpose? In your Keystone Weekends book, there's the conceptual framework. There's 6 statements. Statement number 1 is the purpose of our profession. And it's not unique to the United States. All accounting all around the world has bought into it. So I got you started to make decisions. To make decisions about future cash flow. I didn't make that up. That's straight out of Keystone Weekends, Spicer. And where'd they get that from? Statement of Financial Accounting Concepts number 1. Well, it should be the first statement, the purpose of our profession. To provide information to decision makers, as people inside and outside the firm, to make decisions about future cash flows. Folks, you're going on a job interview and the person interviewing says, what do we do in our profession? Better know. Okay? Statement number 1 from Keystone Weekend. Well, from Conceptual Framework. Okay. Now, I lost track of what my line of thought was.
Capital expenditures, long-term.
Yeah, long-term, short-term. So, we know thank you. Purpose of the profession. Up until today, we've been providing information to managers to make decisions. Has that process been focused on short-term or long-term? Mainly one or the other, what do you think?
Mostly short.
Mostly short-term, and there was a chapter that was definitely long-term. What chapter?
I think it was chapter 4, probably not right.
What's the purpose of the balanced scorecard? Remember chapter 1, it started in chapter 1 and chapter 2, balanced scorecard. What's the purpose of the balanced scorecard?
Keeping balance.
Why does Siemens have a balanced scorecard? Why does Lockheed Martin have a balanced scorecard?
So they can watch their non-financial and financial key performance indicators.
Very good, very good, very good. That's what you see in a balanced scorecard. So what he's telling me is he does recall the chapter, but didn't answer my question. What's the purpose of it? He told me what's in it. That's very good.
To monitor, like, that you're moving in a quantitative direction.
Monitor what? Monitor what? The implementation of the corporate strategy. If you and I have a package delivery business, and 1 or 2 of the drivers are delivering packages to the wrong address, damaging the packages, if we don't monitor that, what's going to happen in the long term?
Those customers.
And that's why you gave me those metrics. We'll measure customer satisfaction. We'll measure cash flow. And if customer satisfaction is going to go down, what probably else is going to go down? Cash flow is going to go down. Profit's going to go down. So corporate strategy, short-term or long-term? Corporate strategy is long-term. Managers make strategical decisions and they make operating decisions. Operating decisions are the decisions we make every day when we come to work, every week. Now, when we make decisions, we dealt with this. When we make decisions in the short term, we will have binding constraints. That's theory. Now, I'll give you an example. Let's go to Bahama Breeze over here at 6 o'clock on a Friday night.
I sort of think you're promoting them.
At 6 o'clock on a Friday night, what do we observe?
Rush hour.
Just that happy hour.
We observe that there are people waiting in line and some people leave. The people that are leaving is of interest to you and me. Why is it of interest? Because when they leave, what is it we lose?
Customers.
Don't say profit.
Customers.
Customers?
We lost contribution margin.
Contribution margin.
We lost contribution margin. That contribution margin would have gone straight to, now I'll take your answer, it would have gone straight to profit. And you know from the balanced scorecard, what must we not lose? Now I'll give you the answer someone else gave, customers. We do not want to lose customers. So in the short term, we want to do what we can to keep the customers. And what should we do at Brahama Breeze to keep the customers? Give me some ideas.
Discount.
Short term.
Discounts on the next one.
We could give them a free drink at the bar to keep them there. We could recognize, well, there are some older folks, why not give them a discount to come at 4 o'clock? And instead of making 100% of the contribution margin, we make 90%. We give them a 10% discount. Now, as long as you keep the customer, where's the contribution margin going? Let's hear it again. Straight to profit. Straight to profit. But we also must consider that perhaps our restaurant isn't large enough. And once we decide to increase the size of the committed, it's called the committed resources. The accounting term is fixed plant and equipment. That's what we'd say as good accounting. But the economist says committed resources. Once we decide to increase the supplies, the correct word, the supply of the committed resources, which costs are going to start going up? The fixed costs. And is that short term or long term? That's long term. That's a different decision situation. Now, if you just automatically say, well, we're losing some customers, let's push the wall out, make the restaurant bigger. Well, you keep the customers, but was it financially smart of you to do that? Because now you've increased your fixed costs. So that decision takes us into chapter 12. That's a long-term decision. Why is it long-term? Because the fixed costs you're committed to for the long term. You're committed to it for the long term. Once you increase those fixed costs, they're fixed. You're committed to them. So how do we evaluate that? Chapter 12. Now, because we're going to evaluate this cost over the long term, what does that necessitate us having to consider? Because it's long term, more than 1 year.
Depreciation.
Time value of money. So we are required to consider the time value of money in this chapter. Now, pages 493, 494, they start the presentation of this very large example. And as you can see, it goes down 102 lines. Okay? It's got everything in it. And it's a bit like last week's budgeting one, went down 350 lines. I cannot, last week, I could not give you a problem that's got 350 lines in it. We could, but we're not going to do that. This week, we can't give you, I can't give you on the exam a problem that goes down 102 lines. Because it's going to take all day to do this. Okay? But what is here, what is in this one, is everything. So, the problem I'm putting together right now for the exam won't have everything, but it's going to have what? much of what's here. And where will you find that? Over in these two right here. Okay? So, what I thought I would do is go over one of these today, which means you'll probably be out a little earlier. And then on Wednesday, I'll go over the other one with you. Okay? And maybe on Wednesday, I'll have the exam problem finished, and I'll tell you a little bit more about it. Not give it to you, obviously, but tell you about it. You with me? So if you're here on Wednesday, and we've been through these two, I'll tell you what's going to be different. You with me? So let's do this first one here. We have this company. What? Too small, can't see it. We have a company, obviously mine's going to be longer than this. It'll be more than this, but this is a multiple choice one. Multiple choice one. And it's going to deal with the major areas in the chapter. So, what are we told here? It's planning to acquire a new machine, $260,000, to improve the manufacturing efficiencies, thereby reducing annual costs. Now, a lot of these problems do not give you sales or cash inflow. What they give you is the reduction in cost. Now, I just told you I've started working on the problem that I didn't have time for last week, but I'll put it on the exam. That's exactly what's going to be in the problem. No sales, nothing about sales, but a reduction in the cost. A reduction in the cost. So it's the same as what we've got here. This is a common approach to these problems. The firm has a minimum rate of return of 9%. So when you see the minimum rate of return, how do we interpret that in terms of this chapter material? The 9% is the cost of capital. So the problem doesn't normally say cost of capital, it says a minimum rate of return of 9%. To be interpreted as the cost of capital. You with me? Everyone okay? Who has not done discounting? Anyone in here not done discounting? Okay, so we should be comfortable with it. The machine will be depreciated using straight line. This one's straight line. You can guarantee, what am I going to give you? Well, I did look at makers, but I've actually already written that part, double declining balance. Okay? But it wouldn't matter if it was makers or double, it doesn't matter. Doesn't matter. The issue is straight line or not straight line. That's the issue. Why is it the issue? Anyone?
The business rates down.
What's the issue?
It's accelerated on them.
Well, it doesn't matter. No, it doesn't matter whether it's makers or double declining balance or some other accelerated method. It's straight line or not straight line. If it's straight line, it makes this really simple because the cash flow per year will be the same. It's when we use a non-straight line depreciation method that you've got to do all the calculations, because then it's a different cash flow amount per year. Okay? So I did think about that this morning when I started work on it, makers or double decline. I said double declining balance. Okay? Now the other reason I did double declining balance, anybody? The sheet of paper I handed out. That was one of the functions on the sheet of paper that firms want you to know. There's a built-in function in Excel to handle that depreciation. And you're saying, well, I don't know it, I bet you can all guess it. What do you think the name of the function is? Give me the symbols. Double declining balance. DDB. That's the actual function. So when you see the token, it's going to say DDB, double declining balance. And for straight line, you a little more difficult to guess this one, but you could probably have a pretty good guess at it. In Excel, what do you think the function name is? You got reason for not knowing this one. SLN. Okay? LN for line, S for straight. So the actual functions in Excel are not that difficult to guess at. Now, I had somebody hand in, I haven't had a chance to look at everybody's work in the weekend, but somebody had men, somebody did this, men with only one parameter. Men suggests what?
Whole column.
You've got to have more than one parameter to have men. I can't say, what's the minimum of your age is? What's the minimum of your age? I've got to have two or more. Okay? So, the first thing we should do when we're using a function is go and read what? The F1 help. F1 help. Now, I don't get, because I have so many students, I don't get a chance to talk to students, but I'd love to talk to the students, say, well, why didn't you try to put something else in there? So it's the minimum of two or more alternative values. Okay, let's keep going here. So this one is straight line, which makes it nice and easy. Okay, makes it nice and easy. Now, tail end of this, 5-year life with no salvage value at the end of 5 years. No salvage value? Feel good or bad? Feel good, right? So on the exam one, what am I going to have? I'll have salvage value. I'll have salvage value. The firm is at a 47% income tax rate. Okay? Now, the estimated internal rate of return. Well, this is multiple choice one, a little easier, but it's got everything there. The internal rate of return. Now, in the chapter, here's what they cover. They cover payback. They cover the book rate of return. Now let's deal with payback. What is payback? Someone explain payback.
How long it takes for an investment to pay you back the money you invested.
That's right.
For you to break even.
That, the number of time periods, and our time period is usually yearly. Okay, so let's do, I'm going to come back to his answer. The time period is yearly, and when does the first cash flow take place? Right now. That's why we say 0. So that's critical, you know that. The cash flow, the initial cash flow is right this moment. And because it's right this moment, the present value of it is the same. The present value factor is 1. Okay? Are we clear on that? So, very important that we recognize these key points. That the cash flow is taking place right this moment. And so we call that year 0. And then in subsequent years, when does the cash flow take place? What's the assumption?
First year.
Wait. What's the assumption? In actuality, the assumption is flawed. But if we try to improve the algebra, it will make it much more difficult. So we're not gonna do that to the student. So I restate the question, re-ask the question. In subsequent years, 1, 2, 3, the assumption of the cash flow taking place is when? At the end of the year. Okay? So it's assumed that it's all taking place, of course it's wrong, it assumes it's all taking place on December the 31st. Okay? So just be careful of the conceptual question, because that's what the conceptual question will try to find out, does the student know that? So we've dealt with the year. Now, let's come back over here. We're talking about long-term decision making. We need to make a decision. Management, you and I, need some criteria. These are examples of what firms use as criteria. So if I've got 4 investment opportunities and I'm using payback, I've got 4 investment opportunities. The one that has the largest number or smallest number?
Smallest.
The smallest number is the preferred investment. So what are we talking about in this chapter? We're talking about long-term. We're talking about evaluating cash flow over the long term and using a number of metrics to do the evaluation. So the first one that's covered in the chapter is payback. And the gentleman is right. What is payback? Payback is the number of accounting periods that it takes in terms of cash flow, not accounting, not accrual accounting, not profit, cash flow, to recover the initial investment. Now, is that a good one or not? Is that a good metric to use? Because there are other metrics. Is that a good one?
No.
What's wrong with it? Doesn't consider the time value of money, that's true, but be a little more specific.
It doesn't tell you how much profit.
Well, what's
Better
more
investment.
important, profit or cash flow? Cash flow is more important than profit.
Well, yeah, it doesn't tell you how much more cash beyond the.
It's not
So
showing
that's
the word
different. Now you
difference.
give me a different answer. And that's the better answer, and that answer's a little bit better than the one I got here. Okay, let me cover that point, because that's gonna come up on the conceptual side. What's wrong with payback? First point, it doesn't consider the time value of money. That's a true statement. But his answer was a better answer. What was his answer? Let's assume that after that payback period, 1 or 2 of these investments have got unbelievable positive cash flow. Extremely good cash flow. Payback would ignore that. So we may penalize, reject an investment when we should have accepted it. But the problem with that investment was you had to hang in there for a number of years before you got the tremendous cash flow from it. So the problem with payback is it rewards managers who focus on short-term or long-term? Short-term. And that's been a criticism of management here in the US compared to other countries, is that we focus on the short term. Why do we focus on the short term? Because the metrics we use give us the incentive to focus on the short term. So that's the problem with payback. Payback motivates you to focus on the short term. But it's popular. Now let's go to the next method. The next method is the book rate of return. Now, in the book, it gives you two ways of doing it. One way of doing it is based on the initial investment. The other way of doing it is based on the average investment. The initial investment is a matter of looking at your net income over the initial cost of the machine. That's rather easy, isn't it? The average investment requires you to determine the book value of the machine at the end of each year. The average investment, what's the book value at the end of each year? So which one's going to be messy? Initial or average? Which one am I going to give you? Average, because it's at home. Okay, so I'm starting to tell you what's on the exam, this problem. So we're going to look at the net income. And why is this equal? Take a guess. Why is it equal every month? Because they use what method of? They use straight line depreciation, which made the income equal each month. So when we're using double declining balance, we would want to look at the average income over the average investment. So that's the book rate of return. Okay? Two ways to calculate it. We tell you in the problem which one to use. The next one is the net present value. Now the net present value, as you've already told me, requires us to consider the time value of money. And when we're looking at this method here, we look at this method, what are we doing? Net present value is equal to the cash flow in year 0, which doesn't get discounted, plus the cash flow year 1 over 1 plus I to the power of 1, plus cash flow in year T over 1 plus I to the power of T, right? Isn't that what we're doing? I mean, better say yes, because you're going to fill the algebra up. This is what we're doing here. Now, you can see that we've got an interesting linear or non-linear. Is this a polynomial equation? This is a polynomial equation. Well, fortunately, Excel's going to help us. Excel will do all of this algebra for us. But we've got to know how to set it up. So I'm going to go over it. And I'm going to tell you the differences between the two examples here and the one on the exam. And I've started to do that. Okay? Now, we're talking about this metric net present value. Well, fortunately in Excel, and it was on that sheet of paper, one of the functions, NPV. There's a function in Excel, NPV. All we have to do is give it the cash flow stream, and what's I?
Interest.
Well, but I didn't use that expression. That's the cost of capital. So that's all we have to give it, the built-in function. We're going to do it, and it will give us the net present value. Okay? Now, let's go to the next one. IRR, internal rate of return. What's the difference between NPV and IRR? Okay, well, okay, I heard, okay, let me repeat what she said. IRR is the value of I that makes this go to 0. She's absolutely right. Okay, so, again, fortunately Excel has a built-in function called IRR. Okay, they also have another one called MIRR. We'll get to that one on Wednesday. Let's just stay with the basics. IRR, you defined it correctly. IRR is the value of I that makes NPV go to zero. Everyone recall that? You're absolutely right.
Yes.
Perfect. Which of these is superior or they're the same?